3 seconds after you deposit money in your bank, something strange happens. The balance appears in your app. The number looks safe, stable, waiting patiently. But the money itself, it's already gone. Not stolen, not lost, just somewhere else. And that uncomfortable truth sits at the center of the modern banking system. Because when you deposit money into a bank, it doesn't sit in a vault with your name on it. It starts working immediately. Imagine it's a normal Tuesday. You walk into your bank, you deposit 10,000 rupees. The teller smiles. Your phone buzzes with a notification. Balance updated. Most people picture the bank doing something simple. A giant safe somewhere in the building. Stacks of cash. Maybe a dusty vault door like in a movie. Your 10,000 rupees goes in and waits there until you come back. But that's not how it works. In reality, the bank just received something incredibly valuable from you. Not money, permission. The moment you deposit money, you are effectively lending it to the bank. Yes, your bank account is technically a loan you give to the bank. They now owe you that money, and like any borrower, they immediately start using it. To understand why, we need to rewind about 500 years. Early banks in Europe started as simple vaults. Merchants stored gold for safety. The banker charged a small storage fee. But bankers noticed something interesting. Most customers didn't withdraw their gold at the same time. In fact, most of the gold just sat there, day after day, month after month. So the banker tried something risky. He lent some of the gold to other merchants for interest. At first, only a small portion, but it worked. The original customer rarely noticed because their gold receipt could still be redeemed any time, and suddenly the banker was earning money from gold that technically wasn't his. That small experiment became the backbone of modern banking, a system called Fractional reserve banking. The name sounds complicated. The idea is simple. Banks only keep a fraction of your money. The rest gets loaned out. Let's go back to your 10,000 rupees. You deposit it. The bank might keep only a small portion as reserves, maybe 1,000, maybe even less depending on regulations. The remaining 9,000, that gets loaned to someone buying a bike or starting a business or paying for college. But the story doesn't stop there, because when that borrower spends the 9,000, the person receiving it usually deposits it into their bank. Now another bank has 9,000 rupees, and it also keeps a fraction, maybe 900. Then it loans out the remaining 8,100, and the cycle continues again and again and again. Your original 10,000 rupees just multiplied across the system. Suddenly, the banking network might support 50,000, even 90,000 rupees worth of loans from the same initial deposit. It sounds almost like money printing, and in a way it is, not by governments, but by banks, quietly, every day. This system powers the entire economy. Loans build houses, finance businesses, fund education, buy cars. Without this system, credit would be scarce. Growth would slow dramatically. But the system only works under one very fragile condition: trust. Because remember, your 10,000 rupees isn't actually sitting there anymore. Most of it is circulating somewhere else in the economy, which means if everyone suddenly wanted their money back, the bank wouldn't have it, not immediately. That's how bank runs happen. One rumor spreads, people panic, everyone rushes to withdraw money at the same time, and the illusion of available cash collapses instantly. This isn't theoretical. It has happened many times. During the Great Depression in the 1930s, thousands of banks failed in the United States. People lined up around city blocks trying to withdraw savings. Many never got their money back. More recently, in 2023, a modern version of this happened with Silicon Valley Bank, except the lines weren't outside buildings. They were on smartphones. Billions of dollars attempted to leave in hours. Digital bank runs. Same fear, faster speed. To prevent total chaos, Governments created safety nets, deposit insurance, central banks acting as lenders of last resort, emergency liquidity programs. These systems are designed to stop panic before it spreads, and most of the time they work. But they don't change the underlying reality. Your money is still being used. And here's the quiet irony. Banks pay you maybe 3 or 4% in interest on your savings, sometimes less. Meanwhile, they might lend that money at 10%, 15%, even higher depending on the loan. Your deposit is the raw material. Their profits come from the difference. It's not illegal, it's not hidden, but most people never think about it because the bank app shows a comforting number, available balance, always there, always ready. But behind that number, the money is constantly moving. Loans are being created, payments are being processed, debt is expanding, and the entire structure rests on a shared belief that the system will keep functioning tomorrow just like it did today. So the next time you check your bank balance, imagine the journey your money is taking. Part of it might be funding a cafe opening across town. Another part might be helping someone buy their first car. Another part could already be flowing through multiple banks, all at the same time. Your money is everywhere, except quietly sitting in your bank. And that raises an interesting question. If most of the money in the financial system is actually loans, then the real foundation of the global economy might not be money at all. It might be debt. And the uncomfortable question that follows is simple. What happens if the world suddenly stops trusting it?